Our economy is either going to collapse in the next 6 to 8 months or we're going to print trillions of dollars into our economy. I want to tell you exactly why. I'm not going to edit this. There's 3 F's: the foundation, the fuel, and the fire. I'm going to tell you who's holding the match and who's putting the fuel there, but let's talk about the foundation real quick. It's the 3 Ds: the debt, the deficit, and the dollar. The debt is growing, the deficit's growing, and the dollar is weakening. It had the worst opening 8 months of a year in the last 52 years. Dollar is weakening. What does this mean? It means that your dollar is worth less. All while a part of that foundation, we've had 5 years of consistent cumulative inflation that we believe the Fed is underreporting, and a job market that is waning. Job market specifically for college grads now showing that a 9% unemployment rate for those with a degree is normal, and a 49% underemployment rate for those with a degree under 30 is normal. And to finalize the foundation, we also know that everything is just generically more expensive, whether you're getting insurance, a car, or a home. Now the fuel. Now I made a video back in April on Liberation Day, actually the day after Liberation Day, having watched it, realizing I just watched the first domino fall in what could be the largest economic collapse we've ever seen. And the reason for that is countries, consumers, and companies. Countries got a slap in the face collectively all at the same time with this new thing that they had no clue was coming, or at least at this amount. Companies now have to pay a higher amount to import these goods, leaving them less liquidity to potentially create jobs, to potentially lower prices. They have to make as much money as they can because they're paying a higher price too. And the last, the consumer. The consumer is going to be paying more because it is going to get passed to the consumer. And in a world where inflation is high and wages are low, this is detrimental. Now clock this one in with me because this is the most important part. Since Liberation Day in April, our bond market auctions have been weak at best, especially long-term debt. And if you don't know what a bond auction is, it's how people buy bonds. If you don't know what a bond is how we package our debt for investors. And if you don't know what that means, just Google what is a bond. You'll find a great YouTube video. Bonds determine rates for you and I. If you want a car, you want a credit card, you want a home, you want to finance a new leg because one fell off in a car crash, you're going to have to look at the residential rates or the retail rates to see what your interest is going to be. And the way that these banks figure out these retail rates is by going off of the bond market. When the bond market goes up, so do rates for everything we do. Now, if you've been watching the Federal Reserve meetings, don't worry, I have if you haven't. They have been talking about a Fed rate cut, and in September, we finally got one. But did you know that the 30-year mortgage rate and car rates actually went up after this Fed rate cut? One of the biggest pieces of fuel is right here. The Fed cuts the rate, but 10, 20, and 30-year bonds go up. So how do they fix this problem? Well, if you ask a free market economist, the market will fix the problem. The market will fix it in time and allow for this topple over effect to happen because there's too much wealth at the top and it needs to be redistributed. But what we saw in 2008 was they invented this thing called quantitative easing to prevent that very thing from happening. See, in 2008, it wasn't just a housing market crisis. In fact, it was a bank failure. And a bank failure is what caused the market crash. You'd be blown away to know how Jeffrey Epstein's involved in all that, but that's for another video. The point of it being is when the market crashed, banks froze up. They weren't lending to one another. They also weren't lending to people like you and I, and we didn't want to get the loans. Why? Because nobody had jobs and rates were too high. See, the Fed started to lower their rate, but what happened to the bond market? The bond market actually went up. This is the only other time we've seen in history recently where that has happened. And the reason it happened is think of yourself as the bond investor. A bond is you getting paid a yield based off the likelihood that at the length of this yield, 10, 20, 30 years being the maturity date, that at the end of that 10, 20, or 30 years, our economy is still strong, our dollar is still strong, and we're still trucking along. So a lot of investors have a little bit of a, I don't know, about that very thought process. We're seeing that in the weakness in the bond auctions. This is a very nonpartisan way of looking at the status of our economy. So we've had the foundation. We know where we sit. There's a lot more we could go through. We've talked a little bit about the fuel. What's laying on the ground right now? We have people that can't afford anything, banks that are starting to get crunched, and a market that we can't get into because rates are simply too high. So what's going to happen next, I believe, are the 3 options for a fire. Bank failure, total collapse, or 2008, in March, Bear Stearns toppled. In September of 2008, Lehman Brothers toppled. This bank failure happened because they were not liquid enough. They went solvent. It means they didn't have enough money per the amount of money they owed every other direction to people like you and I and their investors. Our Federal Reserve and government stepped in to help Bear Stearns from falling, but couldn't do the same for Lehman Brothers, leading to the credit crisis we went through from 2008 to 2009. Right here, and I'll tell you what these yellows are here in a second, but right here is when we had our first bank crisis. Here's where we had our next. And you could see that right after that, this is the 30-year bond. Why did rates drop after our economy just showed some of its weakest potential signs ever? Two giant banks collapsed, but yet the bond investors were like, actually, we want less money back on our investment. We think you guys are doing great. Well, bank failure was also what happened in 1929 that caused the 30s Great Depression. Bank failure is often the trigger mechanism that lights the fire. Now, number two, an economic collapse. Could we get to the point where the dollar is so untrusted, becomes so weak, that we have to completely change systems, that we have to transition to a blockchain currency, a gold-backed, Bitcoin-backed currency, because our currency is no longer what people want? I think that could potentially happen. The reason being is because more and more people don't believe in our dollar, more and more people don't believe in our debt, and more people are watching our deficit gap grow, all while the wealth gap grows, and nothing is being done for the next generation to be able to do anything about it. Could be an economic collapse, but number three is most likely the fire that is going to be lit. Number three, money printing. See, behind me, again, this is when we had our first couple bank crashes, and then the bonds went down. But what I didn't tell you the first time is that these yellow highlights are the 3 times that our Federal Reserve stepped in to buy bonds. Now, let me explain this. When the bond rate starts going high and they want to curtail the supply, what they do is they print money and go buy. That all rhymed. So what they did after these 2 bank failures, as we could see the 30-year started to go up, they began printing money, but not just to throw into the economy. I want to be very clear here. There's bank bailouts, which did happen, and that is congressional. It comes from our government. Our legislative branch and executive branch orchestrate those bank bailouts, and that very much did happen. Look at TARP, look at Henry Paulson. That meeting's crazy. But this is only QE. Federal Reserve money printing. Now, this isn't just money printing. It's not going to the mint. It's digitally made new, and then they use that digitally new money to buy up bonds. But why do they specifically buy bonds? Think of supply and demand. If nobody wants our bonds because they don't trust our economy, what is the one way that we could get the bond to go down, the rate to go down? What would you do if you were selling a banana and you had 20 people that wanted to buy your one banana? You really have 2 options. Either sell more bananas, get more supply to feed the demand, or raise your price and let them fight for it. We saw that happen in the housing market not too recently. So right now, what the Federal Reserve was doing in 2008 was deciding to take bonds off the market so that less bonds were available, thus making them more valuable. Are you catching that? They printed trillions to buy up these 30-year bonds so that the yield would go down and the market would unfreeze. We see it didn't work perfectly because it came right back up. So what did they do just so recently after that? They printed money again, QE2. The rate went down, but shortly after that, right back up. It came down a bit, but then started to seep back up. So what'd they do again? They printed money. We're not talking a few $100s or millions in money printing. They printed trillions of dollars of money. That is a millions. You could buy every NFL, NBA, MLB, and soccer team multiple times with $1 trillion, and they printed multiple trillions. So the foundation's been set. The fuel is laying on the ground floor of the kitchen right now, and it's just a matter of who drops the match. Do we go into bank failure, and that triggers some actions like money printing or bailouts? Do we wait too long and actually suffer a full systemic economic collapse or detethering, allowing someone for like a China to step in as the world's #1? Or do we prolong the debt-fueled economy by printing more money to suppress the bonds, open up more credit, more debt for you and I, and allow billionaires to get even more wealthy? I made this prediction back in April, and I'm restating it right here. I said 12 months then, I'm saying 6 to 7 now. We are right on pace for something to happen, something to crack, and it's going to print millions into our economy. And what that means for you is if the dollar weakens, hold gold, hold Bitcoin. If it all falls apart, just have a good shack in the woods. And if we print just a ton of money and expand our monetary base, everything asset-wise will inflate. Hold stocks, hold housing, hold something that's going to grow with it. If there's anything historically factual that we can look at, is anytime our economy has looked a meltdown economically in the eyes, we usually print money and just have a melt up. This has been a long video. I believe this is going to happen. Stay prepared.